Two things I want to talk about today on this video. One, where's the recession? We were supposed to have a recession. It seems like every month for the last 18 months, the recession is happening tomorrow. Hasn't happened yet. So we need to look at that. And I want to revisit that. And the other thing we have to look at is what is going on with the market, because it is back up to where it was at the end of 2021. And we want to look at one symbol today that almost was cut in half the last time it was up here. And this symbol is important because it often leads the market up and down. Stick around, we'll get to both. I have two more market review videos left. So that's this week and then next week, and then market review videos are over. I've been doing them for about 20 years. I'm still doing them for my money management clients. It's just private. So I want to look at the market today I want to use a really interesting relative price chart. And I also want to talk about where's that recession, because it's not here yet. Whether you're retired or not retired, knowing this information can help you better eliminate market anxiety and be on the right side of the market. So let's jump over. Let me jump over to the price charts. And we're going to first talk about the recession here. So just a reminder, and we don't have hundreds of data points to go back to, but we can go back to hiking cycles, rate hiking. I can't even say it. Rate hiking cycles back to 1968. So we have about 55 years of data. And you can see them on the screen here. The average months, how many months it took from the start of the rate hike, okay, to when the recession started. The average is 22 months. So the Fed started oh my gosh, just cannot speak to the hiking rates in March of last year. So we're about 17 months from then. The average time period it takes for a recession to start is 22 months. They've been, as long as you can see on the screen, they've been as long as 31 months between the hiking and the actual recession, and they've been as short as 12. So there's a big range here, and that's part of the reason, right? There's not many data points, and there's a big range as short as 12 months and as long as 31 months. And we're only 17 months in, so the average is still 5 months away. So a recession still can happen. Right now, I'm guessing the powers that are in the White House right now are going to do everything they can, whether they were a Democratic Party or the Democrats or the Republicans, they're going to do everything they can to stay in power. I could see that recession getting pushed out to the beginning of 2025. So that's just kind of an update on where's the recession. Okay, so I want to show you the semiconductor sector. And the reason I want to show you this is because it is in everything. Semiconductors are in everything. They run the world. A lot of the trade war between the US and China is semiconductors. The reason why Taiwan is so important is because they produce a significant amount of the semiconductors in the world. If they didn't, let's just be clear, we probably wouldn't care about that island. But they are a huge producer, so we do care. It's kind of like why the US cares about the Middle East. It's because there's oil there. So if you look on the screen, this is SMH, no dividends reinvested, just what it is. And here we are. SMH is right back to where it was in 2021. And then it fell 45%. It almost got cut in half. And here you have semiconductors again at that price today. They really tried to break out and break above that, but they couldn't. And so now they're at the bottom of that, looking to break down more. So the question, is that it? Is it over? Is the market going to do another, if you're looking at the NASDAQ 100, another 35% fall, or the semi is going to fall another 45%, which is just about being cut in half? Or is it going to be different this time, and this is just going to be a slight correction? So part of these pullbacks and corrections have to do with what happened in the past. And the fact that, 17 months ago? No, that's more, 18 months ago. Anyway, December of 2021, that was a significant turning point in all equity markets around the world. And we're at that, and we're about to break below. Last week, I talked about how Apple broke above and then came down below. That's called a false breakout. The relative price chart I wanted to show you was 3x, so a 3x leveraged semiconductor ETF. So on any given day, if semiconductor index goes up 1%, this would go up 3%. The next day, if semis went down 1%, this would go down 3%. So it's a 3x leverage. Now, it's not going to get back to the high of 2021 because it's just so leveraged. And when it fell 45%, when semiconductors fell 45%, it can't make up all that loss. But what I want to do show you is semiconductors bottomed in October of last year, and they've been trending higher. Now, this is a relative price chart. So this is a 3x semiconductor index divided by a 1x. And your brain can see how it's been in uptrend since October of last year. It's now testing the bottom of that uptrend. If it breaks through, as in breaks down, that's a sign of instability. That's a sign that we'll have more downside. And because the market is bouncing off that overhead resistance or that overhead supply, these corrections can sometimes have kind of more power to the downside. Now, I was saying to my money management clients, expect a minimum 5 to 10% correction. It depends which sector or index or country index you're looking at. But what I notice is collectively, people don't start paying attention until the market's at least 10% down. And I mean the market, I mean the major market. But here's a nice leading indicator that can really show what's moving faster than anything else. And it can kind of give us an idea to the downside. Is it moving faster? And it is breaking down. In some ways, if you look on the screen there, it almost had a triple top right there and is now breaking down. If you want the market to go higher, you're going to want to see support come in here. Because if it doesn't, it can, there's more movement to the downside. So what do you do? I mean, most importantly is that you are looking at the market as a whole and from a big step back, right? So what we do know is when people get older and their active income goes away, they actually become worse investors, right? Because they don't have the job to fall back on for the next 1, 3, or 5 years. They have to really fall back on their saved money in their portfolios. So we do know that as people get older, they are more reactive. I'm bringing that up because the majority of the wealth in not just the United States, but in the stock markets around the world are held by people over the age of 60. And certainly when you get over the age of 65, the majority of those people do not have active income anymore. So there'll be more volatility, and we're up at one of those turning points. This price chart is the NASDAQ 100 QQQ. And you can see it's turning back at this point too. I did talk about Apple. And so there it is right there. It did, the idea was that it broke out to new lifetime highs, became a $3 trillion company. And it looks like now it's going to fully break down below, which is called a false breakout. Notice it kind of did that down here at the end of last year and the beginning of this year where it broke down, but it didn't fully break down and then it went back up. That would also be a false breakdown to the downside, and false breakout to the upside is what's going on right now. So the market is digesting a lot of information. Part of what it's really trying to figure out is what is going on in Japan. Japan's on fire. Their rates are going up. The stronger the economy is in Japan, the easier it will be for the Japanese central bank, to let rates go higher. And what happens over there impacts bond markets all around the world. Add on top of that, Japanese and Chinese, the countries, were the biggest buyers of our debt. They are now the biggest sellers of our debt. So our second and third biggest buyers, our first being US citizens and US government, they're not buying anymore. They're net sellers. And now Japan's raising their rates, which is affecting the United States long-term bonds. And that's why you're starting to see the yield on long-term bonds, think 10, 20, 30-year bonds, starting to move higher. Now, people are saying, no, they can't move higher because we're getting a recession and the Fed's going to drop rates. I started this conversation off saying the average time it takes is 22 months. It can be as long as 31 months. So if we go the long way, that's 14 months. The Fed could keep rates at 5.5% for 14 more months before they start to drop them. I don't think people are expecting that, which means the price of long bonds can fall even more because of that, and because Japan's long bonds are, well, rates in Japan are going up, their long bonds are going down. So people are saying, hey, maybe I'll get some Japanese rates. Thank you for being in my world. I appreciate you watching my research or market review videos. I'm attempting to speak too fast. I started doing market review conversations back in 2003. They were in person every month when I lived in San Francisco, and then moved down to Silicon Valley, and then I moved them online. And so this is the second to last market review I'll have for non-money management clients. Thank you for being in my world. Thank you for leaving comments. I read them all. Thank you for liking and subscribing. The videos will continue. They just will not be market review type videos, but I will continue the videos. They'll be really focused on making sure you retire strong. Are you doing the right things? And a big part of that is what I call eliminating replication. Typically, there's a missing 3.5% from someone's portfolio simply because they have replication all over it. So I just want you to hear that again. 3.5% annually is missing. That's without changing your risk profile or bringing in any more volatility. It's just literally eliminating replication from your portfolio. If you want to know what that looks like, you can get on our calendar. It's in the description below. Thanks everybody for being in my world, and this one and one more time for market review. Okay, thanks. Bye.